I thought I'd talk about something uplifting like the 2007 to 2009 financial crisis. And you know, I've really appreciated all the talks today. I can't tell you a lot about what the human brain is going to look like 100 years from now, but what I can promise you is that at least one or several of those brains will come up with a credit default swap, which will circumvent whatever regulation has been put in place, and will then activate the greed portion of a whole set of investor brains, and you'll see a lot of what you saw in the last couple of years continue to happen. Okay, so with that said, I'm going to tell you a bit about the causes and consequences of what happened in the last several years. And there's never one particular thing that is the cause, but I'm going to hit a lot of the highlights. And then I want to talk about a couple of my favorite bank panics and financial crises and draw some parallels between both how they happened and the kind of things the government did to stave them off. And you start to see these amazing parallels between things that happened today and happened in hundreds of years in the past. Okay, so even if you've been living in the basement of Fidel, you're probably aware that that house prices have something to do with the financial crisis we've just been through. And in fact, if you look at, there was just this enormous house price growth that took place, particularly starting in around 2000, when the prices grew way faster than inflation. And if you look at the first 80%, the first left-hand part of the graph, you could learn, only watching up to 2007, the cardinal rule, which is that house prices never go down. And this was known, this is a deep law of physics that was known both to all mortgage bond salespeople and to all the rating agencies that decide what rating should they put on a pool of mortgage assets. And because of this great news that house prices, at least aggregated across America, never go down, that enabled the banks and investors to do wonderful things, like you could start giving money to people who had virtually no ability to service that loan because, well, the collateral was only going to go up. So we came up with a lot of great products. You know, some of my favorites were the Ninja loan. That's for someone with no income, no jobs, or assets. And then you got your no-doc liars loans for people who would rather not say whether they have a job or what their last name is. But my favorite, actually, unfortunately, is embedded in one of the stocks that I currently own. The pick-a-payment loan was invented by Countrywide. And in the pick-a-payment loan, the borrower gets to decide whether they'd like to make a payment this month or not. So that was a really popular loan. That was a great product. So popular, in fact, that Countrywide then had to be bought by Bank of America within about 8 months. So we had these great products. The banks weren't so worried about them because they hoped to not be holding them for very long, because we took all the loans and we bundled them into private label mortgage-backed securities, and then we sold them off to folks. And the great news is that we sold a whole bunch to townships in Finland. We sold some to banks in Germany. Unfortunately, we didn't sell very many to the Chinese or the Saudi Arabians, and a bunch. Before the thing came crashing down a bit faster than people expected, and as a matter of fact, a lot of financial institutions in the U.S. were holding some of these. In their portfolio. Now, one of the things I should tell you about these mortgage-backed securities is that we took about $1 trillion in subprime mortgages. We tranched them so that not every tranche had would face the same rate of default. The top tranches, the top 80%, were protected because they would never see any defaults because, goodness forbid, someone defaulted. It would be the lower rated tranches that had a slightly higher interest rate would bear that. And so these top tranches were happily rated AAA, and anyone could buy them, and it was all wonderful. And then, of course, then they said, well, just in case there ever is a default, maybe we could find someone to write an insurance policy so that those investors will be fully protected. And it's generally difficult to find someone stupid enough to write that insurance policy. Those people are thin on the ground, but our friends over at AIG had as their motto suggests, the strength to be there. So they wrote, and thanks to their wonderful system, we're all now investors in their company. So congratulations on that. And they wrote protection. They were willing to sell credit default swaps on tens and tens of billions of these. And unfortunately, the people who were using them as their insurance agent didn't realize they were everybody else's insurance agent either. And what was worse was many folks at the time, at least as of 2004, 2005, did not realize that a mere 7% drop in house prices would wipe out not just that bottom 20%, but the entire structure of these mortgage-backed securities. And again, these things totaled in nearly $1 trillion. The typical bond issue was like an $800 million bond issue. So there you have it. This is what AIG did. And things, by about 2006, 2007, hedge funds started to sniff around and think, maybe some of these house prices could actually go down. Maybe this idea of giving money to people who swear they're not going to make the first payment or pay it back could be an issue. And so they were asking investment banks for the ability to buy credit default swaps to bet against the mortgage market. And by then, it was becoming very difficult to do that. And so several of the banks, Goldman Sachs included, invented the synthetic bond, where there were the price would actually track, the price of this credit default swap would actually track the prices of ones that were already trading in the market. No one other than AIG and ABN AMRO was willing to take the other side of the trade. And so this is how we got ourselves into a situation where hedge funds were able to bet billions on a crash in this market. And a couple of banks bore the cost of it. The problem is that, this is great. So we did this. It was a lot of fun for a couple of years, and we destroyed the global financial system. The problem is, several banks wiped out all the equity capital that they had, and nobody knew which banks were safe and which ones were not. And so you get into a situation which we call a banking panic, a mess. No one's willing to lend to anyone. And that's where the central bank comes in. This is the Fed, and this is the Fed's balance sheet. And what you see in ordinary times is they're mostly holding Treasury securities. You can see these, that's the tan, with a little bit of gray that's lent out, which is lent out to banks. However, in a crisis of this magnitude, the liquidity has to come from somewhere. Otherwise, there's going to be no money for businesses to borrow, to use as working capital. There's going to be no ability for people to borrow to buy autos. There's going to be no ability for people to buy homes. And so there was a complete freeze in the financial system, far in excess of what you would have expected from, say, the $1 trillion loss that had been created by these poor instruments. And so the Fed went on a buying spree. And they bought, the thing that's most significant about this graph is that upper tan part, where they currently hold about $900 billion in mortgages. Most of these are mortgages that were purchased by Fannie Mae, bundled up into Fannie Mae, much higher quality mortgages than the ones in the private label tranches that I told you about. And they're now sitting on the Fed's balance sheet. And I would argue that's a good thing, because that helped unfreeze the credit markets. The Fed played its role as lender of last resort. And so I am very much in favor of what happened. When these massive crises happen, there has to be some sort of coordinated action. And people of a libertarian bent, myself included, all of a sudden get very silent when something of this magnitude comes along and there seems to be no other way to solve it. Okay. But it's not just about the Fed, because as you know, the Treasury also got in the game. Here's a more detailed breakdown of what's inside the Fed's balance sheet. And the only thing I wanted to call your attention to are there's some thin little stripes there, maiden lane 1, 2, and 3. The Fed's also happens to be now the biggest holder of toxic assets. These are things that they acquired from Bear Stearns and from AIG in the process of selling off those firms. And so they now hold the deeds to a whole bunch of low-quality hotels, motels, real estate that probably shouldn't have been built on. And those assets, though, since they took their coordinated action, the value of those assets has been going up and up and up. So the amount of money that we stand to lose has been going down as the crisis has abated. This is, for example, their lending to broker-dealers. They at one point had lent out $150 billion to those institutions, and now we're back down to zero. They had another facility that was used for making loans to high-quality, to pools of high-quality credit card and auto loans. And this is and then elsewhere I've got I told you about their holdings of mortgage-backed securities. Okay. And one of the big policy questions in the next couple of quarters is going to be what happens when they start to unwind that big position they've got. Okay. So now the Treasury, of course, that's only one half of the house. In fact, people didn't even realize that the Fed could take such extreme actions. Really, what you typically see in a crisis like this is you see fiscal stimulus. The governments start to spend money in order to replace aggregate demand that has disappeared. And so you have the famous TARP, the Troubled Asset Repurchase Program, and we had the stimulus spending. And if you didn't know, we're currently running like a $1.4 trillion deficit. About half of that is due to the stimulus spending that we're doing. And that's why when you drive up and down 89, let me talk about the TARP first. I've got this slide up. It was $700 billion. Much of it was used to buy preferred shares in a whole series of banks and brokerage firms that had been converted to commercial banks. We made a ton of money on this. The preferred shares paid 5%, and they included warrants. So if share prices went up, which they did, the government would benefit. And so initially, this was like about a year ago, we had estimates of how much we were going to lose. Now, autos, you always have to lose money in autos. That's just the fundamental rule of investing in auto companies. And so we're clearly going to lose more than half of what was injected into General Motors Acceptance Corp. And the automakers themselves. But most of the stuff that went into banks is we've actually made money on. This is an old slide. These now turned out to be profitable investments. The foreclosures, that is from the home affordable, affordable mortgage program that actually subsidizes banks to modify terms on loans so that people can stay in their homes, and so that we intentionally lose money on that. There's no possible way that we can that we'll recoup that money. But most of the investments in banks, and even the horrible investments in AIG, have turned out to be less bad than expected. I have a challenge to the students in the room. This is a chart that the Wall Street Journal put together, and the newest projection is that we're going to lose $89 billion on the bailout. It is impossible to understand this chart as far as I can see. So if anybody can come and explain it to me, I will give you a Pop-Tart and a box of Girl Scout cookies. So you'll find this in the Wall Street Journal. The $89 billion is right, but what else is going on the chart is for you to tell me. Okay, now also stimulus money. As you drive up and down 89, you'll notice there's now always a traffic jam, at least as far as you're coming north. And then there's a big sign as you're parked there that says, thanks to the American Recovery and Reinvestment Act. And so all that replacing of guardrails that's going on there, and they've repaved sections of it twice now, that's what stimulus money does. But also it funds a lot of research. Research dollars are a lot more plentiful. And there's lots and lots of federal programs that exist at this moment that did not exist 4 years ago. Obviously there have been tax cuts. There's been extension of unemployment benefits. There are a whole host of programs that now allow municipalities and states to not fire teachers, firefighters, and policemen, and that's all part of the jobs creation. And they're wrangling about doing more of this in the next 2 quarters. Okay. Let me make one quick point about these real estate losses. So the real estate market's like a $20 trillion kind of market in the US. And at most, I said that we destroyed maybe $1 trillion worth of value on the balance sheets of these banks. And yet, we had a $10 trillion loss in the stock market. So this shows you, even if my numbers are off a bit, this shows you there's an enormous multiplier effect. When bad things happen to the financial system, we all get hurt. And unemployment went to 10%. And so lots of people who had nothing to do with this nightmare found themselves out of work. And so that's why there's a big role for government in this kind of thing. Okay, but this is nothing new, as I stated earlier. These are just the 12 bank panics that happened between 1820 and 1920. And they come along with great frequency. They were different in these days because we didn't have the Federal Deposit Insurance Corp, but that has brought some strange issues of its own. I want to tell you about my favorite bank panic, which is the panic of 1907, and you'll see why it's my favorite in a minute. Okay, so it starts out rather innocuously enough. There's about at least 12 different causes, but I'm going to tell you about the 2 most proximate ones. There's a big earthquake and fire in San Francisco, and it destroys about half of the capital stock of the housing and the business commercial real estate in San Francisco, which is terrible for the people that own these buildings. However, most of them actually, it turns out, are insured. The great-great-grandparents of the people running AIG were also writing insurance, and these were insurers based in London and New York. And so just an enormous amount of gold has to be shipped then from London and New York to San Francisco, creating a real liquidity crunch. This is why you don't want to be on a gold standard. This is why if you're the United States or you're Great Britain or you're Europe, you don't want to be on a gold standard because you can't compensate for these bizarre events and these liquidity problems. And so all the liquidity ends up on the west coast of the United States. Money is very tight. Interest rates are very high in London and in New York. Okay? Now add to that this gentleman named Otto Heinz, who has very poor timing and decides to run a stock jobbing scheme where he's going to corner the market in the company he manages called United Copper. And this scheme, he's going to use a lot of borrowed money. He's going to drive up the price, and he's going to make a lot of money as people he thinks that are short his stock are going to have to come crawling back to him. Well, it doesn't work out very well. He managed to wipe out his brother's bank, Mercantile National Bank in New York. He wipes out the brokerage firm, Schlieberg, that had lent him the money to buy all the stocks. And so within one day, he's destroyed a couple of mid-sized financial institutions. That would be all well and good, except that a real feeling of panic grips the city. And the next bank that comes under suspicion is this one. You see this picture here on the left-hand side. That's called the Knickerbocker. It was the most beautiful bank building that had been created in New York up to that time. It had, in the central banking room, there were ceilings higher than this. There was an enormous vault with something like 2,000 secure safe deposits in the box. It was all mahogany and granite. Unfortunately, it's now a Duane Reade. But before this crisis, it was an absolutely gorgeous building, and they had lent a small amount of money to Heinz, and he had used part of it for this stock jobbing scheme. And so, turns out that the president of this bank ends up committing suicide. This gets in the papers. The clearinghouse, which cleared checks for them, decided they're no longer going to clear checks, and people line up outside the door. 3 hours before the bank opens, there is a line of people out the door waiting to take their money out. And even though the bank, in the long run, probably had enough assets that their assets exceeded their liabilities and they were actually solvent, that didn't matter because more than all the liquidity they had was gone. Okay, so that's fine if it's just going to be the destruction of one very nice bank. It's a little bit sad. The problem is that runs start on other banks. And the next one in line is called Trust Company of America. Why is there a run on TCA? Well, merely because it was another really well-capitalized, well-thought-of trust company. People thought, well, maybe it's going to be the same story over there. So runs are starting on banks all over New York, and there's even one in Rhode Island. Okay, we've got a problem. We don't have FDIC insurance. It's going to be another 2 banking panics before we realize that we're going to need that. We don't have a central bank because Andrew Jackson has let the charter for the Second National Bank of the United States expire. There is no lender of last resort officially. However, we have something better than that. We have my hero, J.P. Morgan. And so J.P. Morgan, he's about 70 at the time this happens. He does business. At the time this happens, he's actually away at a Methodist retreat, which is, believe it or not, his favorite activity is attending these prayer services and contemplating. He's called back to New York. He sits in his library. This is actually Dartmouth at great expense has recreated what J.P. Morgan's library looked like. And he's sitting in his chair. He's got a terrible cold, actually. And he's having to deal with this problem. And he's effectively the central banker. So he's sitting in this chair, and everyone is coming to him with these problems. And one of the people working with him is George Baker, who was also fabulously wealthy, ran National City Bank in New York, and later gave the money for Baker Library, as well as the Baker Library at the lesser institution in Cambridge, Mass. And so he's surrounded by both George Perkins, who's his CFO, and the other bankers from around the city. And all he wants to know is this TCA solvent? Do they actually, in reality, have assets that exceed their liabilities? Is it possible to save the institution? And he doesn't want to know any details, and they say yes. And then he tells the other people in the room, the other trust company presidents who are about to see a run on their banks, you need to lend TCA money, and they will not do it. And so he says, okay, fine, I'm going to do this. He demands, and literally there's an enormous line outside. Meanwhile, about 10 blocks away at Trust Company of America, money is stacked floor to ceiling in front of the tellers who are giving it out as fast as they can. They keep themselves down to 2 teller windows because they want to limit how fast the money's going out the door, but it's still going out the door. And every couple of minutes they send an urgent message to J.P. Morgan saying, we are about to run out of money. We're going to have to close this bank. This is a nightmare. And so he says, you need to take every valuable security in your vault and bring it to my library right now, which they do. Bags, about 10 guys with bags full of paper securities come up to his library. They quickly, they lay them out all on his table, and they strike them at about 80% of the valuation that they think they're worth, and they immediately start shipping gold and currency over to Trust Company of America, and they save that bank. The problem was that this was such a severe crisis, he had to do this, he had to perform this act of forcing other folks to lend to seemingly doomed institutions about 5 other times in the next 3 weeks. There was a similar crisis on the New York Stock Exchange where there was no money to enable brokers to borrow to run their businesses, and he solved that. And so he did this, he repeated this exercise about 4 other times, and he saved the financial system. And so that's why it's just a fascinating story, but one that's very similar to what we've had, to what we've seen in the past. And if you look at, this is what the Dow Jones was doing in JP Morgan's day, and literally if you multiply this by about 150, you'll see that it's very much like the pattern that we had before. And I have a couple of colleagues that study these crises and what are the determinants thereof. And you see very similar patterns. It takes about the same amount of time as we've been through. So to conclude, can I promise you that we'll change regulation to try to limit so that exactly what happened before, it doesn't happen again? Yes. However, can I promise you that we will have more bank panics and more financial crises? Yeah, we're gonna have them. And so that is my talk. Thanks very much. Thank you.